I'm Tom Cole. I'm one of the founders of Distillate Capital. Jay Beidler joining me, and we're going to walk through the slides. And John Olson is joining us here today as well, and we'll all be around after the fact to answer any questions you might have. Stephanie already mentioned the sign-up sheets for those of you who would like CE credit from the CFP organization. And we've figured out once before that unless we have your number, that becomes really hard to make sure that we get you credit. So be sure to fill that out. The other thing before we start, Jay and I would much prefer to address your questions and just prattle on endlessly, and we're both very capable of doing that. So be sure to wave and interrupt us should questions arise for you.
Throw a hand up or just shout out. Tom's been heckled in the past, so it's nothing new to him.
It's a point of pride being heckled in our industry. So about us, the firm is relatively new. We started in 2017. There's a chart in here which tracks my history. I go back to the mid-'80s in the industry. We're a value equity or value-oriented equity shop based in Chicago. The four of us own 100% of the business. We have about $2.1 billion in assets that are available in ETF and SMA strategies. That's us. So what are we going to do today? Actually, these 40 words over on the side really do sum it up. Valuation measures need updating. I'll just read it. Due to the evolution from physical to intellectual investment, and related accounting distortions, which we could spend a lot of time there, and I promise not to. Traditional measures of value have lost meaning and efficacy, and as a result, they need to be updated and rationally defined in an asset-light economy. And that's essentially it. We're going to talk about that in terms of the problem and the solution to it. And then in the same context of the way we think about valuation, we're going to spend a bit of time at the end talking about the current market environment through that lens. Before I start, and at the risk of potentially entertaining only myself, I'm going to ask you all a question. And it's a profound question that you need to actually contemplate and make an assessment about. And the question is this: what is the first thing you know? So, that generates a lot of thoughts, and a lot of people come up with a lot of various answers. But in fact, there's only one accurate, real answer. And the answer to the question of what is the first thing you know is old Jed's a millionaire. Okay, so if you got the joke, it was and I can tell most people did not, the line is from the jingle that went into the Beverly Hillbillies jingle in the TV series back in the 60s and 70s. And the only reason I raise it is that if you remembered that line in that jingle, you probably were old enough to remember when value investing actually worked the way it was advertised. Since then, it's been kind of a crap show. Maybe before I plow into all of it, just a statement or two or a couple of thoughts about value investing. It's hardly new, right? I mean, Benjamin Graham wrote The Intelligent Investor 76 years ago. I looked it up today. In terms of when it started. And the very simple concepts that he spoke about in that book, I think are still as intuitive and appealing as they were back then. And obviously, there are a great number of practitioners in our industry who have taken those concepts, and notably Buffett being his number one student, to great success over time. So I would say, sort of the most important ideas that came out of that work were the idea that you need to think about investing like an owner. Take a very long-term time frame. If you're able to buy stocks at cheaper prices, not only should that give you more upside, but it should give you downside protection. He also talked about Mr. Market being this grumpy man on certain days that walked down the street that hated everything and didn't want to own anything, and in other days being Mr. Euphoria in that they were willing to pay anything for any stock. And for a long time, value worked pretty well. And we're going to go into that, and we've got a bit of a proof statement into here about how simple it was to add value in the marketplace. But it stopped working a while ago, at least in its simplest form. And even in the time since we launched Distillate in 2017, value has been up about 98%. But that's half of the level that the S&P has been up over that period of time. So how can a strategy that proclaims to buy low-price stocks chronically underperform the benchmarks over that long a period of time? And again, there is an answer to it. It just requires us all backing up and taking a look at the state of our economy and what's changed over a period of time, and then understand the accounting pronouncements and how that translates into the accounting that we're all forced to use when we assess companies that might be a part of our clients' portfolios. So the old economy, starting with the pre-war days, and it's ironic that we're talking about this at a time when tariffs are taking all of our attention and headlines in the interest of potentially bringing manufacturing back to the United States. When the accounting rules were being written in the post-war period in the 50s and 60s and 70s, we were largely an economy driven by physical activities. When you look across the leadership in the market in 1960, all these companies did physical things. They built cars, they built typewriters, they strung telephone lines, they extracted oil from the ground. But by and large, they built plant and equipment that ultimately generated products, that generated revenues, that generated profits and cash flows for their investors. When you look at that over time, you start to see a pretty dramatic change. By 1990, we just leaped ahead, obviously, a few years. You see Bristol-Myers on the list, you see Merck on the list, both of those companies obviously in the pharmaceutical development industry. You see Coca-Cola on the list. They didn't get there by virtue of having better trucks or better syrup dispensers. They got there by virtue of being branding geniuses and having that red ball that they could hang anywhere in the world and get a line of customers. By 2020, what you notice in terms of the leadership of the market is it's almost completely changed over to businesses that are driven by intellectual activities, research and development, software development, more branding stuff. I mean, there's a couple on here that obviously do physical things. Berkshire has obviously a meaningful railroad business and other physical assets, but the changeover is very clear. You see it in the leadership of the market. If alternatively you look at the national income data, you see essentially the same thing. In this case, we're tracking tangible activity as a percentage of GDP, which peaked in the early 1980s at around 11% of GDP and is now around 6.5%. You think about that in the context of the size of our economy, that's a meaningful decline. So in fact, that manufacturing economy that existed in the United States has declined over a long period of time. What's obviously made up for it is the fact that intangible investing activity is just slowly and steadily increased over a time and now exceeds the level of capital spending or traditional capital spending. And when you look at public companies specifically, I don't have a slide here that would capture this, but as recently as 1975, research and development was something like 15 cents for every dollar of capital spending among public companies. And now the level is inverted, and research and development is something like 2 or 3x what the underlying level of capital spending is in the economy. Do you want to take over?
Sure, yeah. So if you, go forward a slide. So if you use a company example to see sort of how this manifests in real life, you'd see, so we have two companies that's hard to see, so I'll talk through it. So Royal Caribbean, obviously very physical asset-oriented company, the cruise ship operator, lots of capital expenditures every year. And we contrast that with F5 Networks, sort of the cloud computing company, so a very asset-light company. So it's sort of more on the right of that chart that Tom showed a couple slides ago, that sort of more represents this intangible economy of today. And the way that the accounting rules work is that F5 is investing largely in R&D, and Royal Caribbean is investing largely in capital expenditures. And those get treated very differently, again, because of these accounting rules were written when the economy was kind of more homogeneously this physical asset-oriented thing. So to walk through an example of that, if you look on the far right, we put everything as a percentage of sales. So you'd see you go down, you get net income as a percentage of sales for both Royal Caribbean and F5, and they're both about 20%. So you'd sort of say, all right, they both have kind of similar net income margins. The issue, though, is that for Royal Caribbean, that net income item reflects a lot of the capital expenditures. It does not fully reflect a lot of those capital expenditures that are taking place, but for F5, all of the expenditure on research and development is already kind of in that net income number. So we show that in this sort of lighter green, where you could see it's sort of 0% of sales goes into R&D for Royal Caribbean, and about 17% of sales goes into sort of investment for the future for F5. So if you keep going down, you get a cash flow from operation number that looks very similar. So they're both about 35% of their revenues are turned into cash flow from operations. But then if you keep going down and you layer that capital expenditure back in for what you as an owner get from the company, you'd see you have a very large CapEx number for Royal Caribbean that takes that free cash flow number from 35 for the cash flow from operations all the way down to about 10% or 11%. And if you do the same thing for F5, you have a very different looking free cash flow margin. So only 2% roughly comes out for capital expenditures. And so you get two companies that might look similar in a lot of different ways and on a lot of the sort of the older metrics, but they look very, very different on a free cash flow basis as a result of one of them being largely an R&D oriented company and one of them being largely a physical capital expenditure company. There's also a lot of debt at Royal Caribbean and not much debt at F5, which is also sort of relevant. So if you go in the bottom table, you'd come up with very different conclusions about which of these companies is cheap. F5 generates kind of nothing in the way of book value. Those R&D investments don't get capitalized. They don't get put on a balance sheet. So it doesn't create much book value. Their book value is going to be their home office and furniture and things that are pretty irrelevant to their ability to generate profits and free cash flow. Whereas Royal Caribbean's book value is going to reflect all the cruise ships it runs and so on. And the PEs will also be very distorted from one of these to the other in the example that we saw, because you're reflecting one of these companies' investments in that PE number, and you're not fully capturing the other ones. So if you go to the next slide, on the top left, you can see this is a price-to-book valuation. For F5, it's kind of a meaningless number. I don't care what the price is relative to their physical real estate footprint, office, furniture, and so on. Yet that's what a lot of value investors are focused on, or a lot of the benchmarks focus on the price to book. So we think it's kind of an irrelevant number for F5. It's higher, it's almost triple. If you look at PE, F5 again looks like the more expensive company on the basis of price to earnings at 17 versus 13.5. These are some older data. We've been using this example for a long time. But then if you look at things on the basis of free cash flow yield and you layer in the debt, so you get a free cash flow to enterprise value yield, you get a very different conclusion than you would have from these other metrics. You get a very big, almost 10% free cash to enterprise value yield for F5, and you have kind of a negligible 3% yield for Royal Caribbean. So because of this economic shift, you're suddenly getting a big disconnect between differing measures of value. And that's sort of where we think a lot of investors are making a mistake, and there's a need for a correction.
So kind of building on this, just for 1 second, and not to belabor it, but the other way you could think about this is, in order to make these things comparable in terms of accounting for things in an R&D driven world, If you went back in time, if you were General Motors, and you were putting a new assembly facility online on Janesville or Tarrytown or somewhere like that, you would have, in order to be able to make accurate comparisons of valuation using earnings or book value, you would have had to run the cost of that entire assembly facility through the P&L the year it came online. So not only does this problem create this comparison issue when you're looking at businesses that either build things with capital expenditures or R&D, but you've created this monstrous problem over time when people try to aggregate the earnings and say, the S&P is trading at a higher multiple now than it did in the 1960s, because the composition of your earnings is no longer consistent over a long period of time as well. So traditional value stops working. So, the basis of value and the reason part of the reason it became as popular as it did is because it was so simple and it was so powerful, right? The top of this chart is simply buying low price to book stocks. All you needed to do, starting in 1960, was divide the market up on the basis of price to book, buy the least expensive stocks, and go to the beach for 3 months and come back and do the same exercise and repeat. And for 30 years, you outperformed the market. Now, it was a dreadful 30-year period for the market, but you outperformed to the tune of 8x. So it was sort of everyone's ticket to be Warren Buffett if you had that much foresight to do it. If you go through that exact same exercise, starting in 1990 with book values, not only are you behind, you haven't added any value, but you're behind at this point. At one point in time, coming out of the internet bubble, it worked for a short period of time, but for the most part, it hasn't. And we would posit that the reason for this is not that value has stopped working, it's that the metric that you're using to measure valuation has stopped working.
And that 60 to 90 period matches up perfectly with that first slide that Tom showed on the constituency of the market. Sort of when everything was physical asset oriented, it was dominated by GM and Union Carbide and DuPont and so on. And then we saw in 90, he highlighted that we started to see this inflection towards more asset-light companies. So that's why it worked from 60 to 90 when all the companies were largely kind of doing the same type of activities. And then it sort of broke down as we saw that economic transition occur.
So Jay wanted to cover this slide and read every word to you, but I insisted that he not. So GAAP accounting, we spend a lot of time talking about R&D versus, physical assets versus intellectual activities and how they affect accounting. And it probably is the single largest problem with value investing. It's the single largest problem in the context of understanding and getting to more accurate comparisons of valuation when you're using accounting statements in the market. But we could spend a lot of time, and we won't, talking about accounting issues. Accounting is like any other regulatory function where businesses over time lobby and they get things changed sometimes in the direction they want and sometimes in the directions that they don't want. Things like non-cash charges, mark-to-market accounting. Mark-to-market in particular was the thing that caused Warren Buffett to suggest his own earnings per share number for Berkshire had become a useless statistic. We spend a fair amount of time in reverence with Buffett because we think he's the world's greatest investor. And when the world's greatest investor tells you the metric that everyone focuses on is a useless statistic, we kind of think that's a meaningful point of reference. He also threw out, and I'm sure most of you are aware of this, he used to run a comparison of book value as a measure of his value add over time, and that obviously doesn't make any sense any longer either. The other big thing that has happened with accounting is non-GAAP. We said here that 95% of the S&P 500 now uses non-GAAP. I looked up the current number this morning. It's actually 97%. And PwC and Deloitte are very politically correct in not telling you that their own clients' non-GAAP reporting largely goes to the benefit of the management teams in place. But I think we all intuitively know that that's the case. And some of the off-the-cuff analysis that have been done suggests that something like 80% of those non-GAAP adjustments do go to the favor of the management teams. So if you're trying to use typical accounting metrics like earnings and book value to measure valuation, and you're faced with 4 different versions of earnings per share from GE every quarter, and you're trying to make an accurate comparison to the 2 different versions that Honeywell reports, I would suggest you have a fairly meaningful problem on your hands. The answer, though, is that if you go back to something Benjamin Graham said 76 years ago and think like an owner, it is the worth of a business is more determined by what you can take away from it than what you put in it. What you can take away from it is the free cash flow. And when we talk about free cash flow, we're talking about the cash available to do dividends, to pay dividends, to retire debt, to do acquisitions, to repurchase shares. It takes into account all the uses of cash, including capital expenditures. Now, it's one of those things that's easy to say and a little harder to do. It requires a fairly in-depth level of understanding about the accounting pronouncements. You have to make sure that you're thinking about things in the context of the lumpiness that's inherent in free cash flows. Sometimes you see people use lagging 12-month free cash flows, but the market's a forward-looking mechanism. And in that context, there are obviously important inflection points in the world around commodity prices, around patent expiries, and other things that should cause you to think more about future free cash flows than trailing free cash flows. So there are a host of reasons to use free cash flow, but you still have to be fairly careful in the way that you apply the work.
So this sort of replicates the book value example that Tom showed earlier, where we saw that it worked wonderfully from that 60 to 90 period, and then it really broke down from that 90 period until today as the economy shifted. So the good news is you could sort of replicate that exercise using this measure of free cash flow that we use, that, as Tom mentioned, sort of smooths out some of the variability in working capital or capital expenditures and makes a couple of other adjustments. And if you do that and you go back to 1990, in that same period that book value struggled so much, sort of the traditional measure of value, in that same period that measure struggled so much, a free cash flow based measure actually did very well. So you can see the index performance here on a log scale. The cheapest quintile did the best. The next cheapest quintile was second best. The third cheapest quintile was right in the middle. The fourth cheapest, or the second most expensive, was the second from the bottom, and the most expensive quintile was all the way on the bottom. So you got this really nice stair step of valuation in that same period that book value sort of failed us as investors. So we would look at this and say that value investing absolutely did not struggle. It did not fail in this period. It's just a function of what measure of value you're using. And if you're using one that we think is a bit anachronistic and no longer kind of makes rational sense in this asset-light world, then you failed. But if you were using a measure that kind of cuts through all of those issues that Tom talked about, you were successful. And we then contrast in this bottom slide, we show that same thing that we showed before, the 1990 to today version of price to book. You can see it's underwater, that black line. And then here's just that long short of the cheapest quintile of free cash flow versus the most expensive quintile. And you can see a sort of a giant alligator jaws type of chart between those two, where one was very effective and one was not. So another measure, so PE, which we saw in that Royal Caribbean and F5 network, PE is also sort of distorted and can give you some nonsensical measures. So we just picked a couple of different stocks. You can see in the top chart, this is a price to earnings on next 12-month estimated net income. You can see it's really hard to make much of that. You've got Amazon in the purple at the top, it sort of goes off the page at some point. You get a number that doesn't really mean anything. You see similarly for Hess, the oil company, at times it's negative. Sometimes it looks like Hess is the cheapest company. But you get this kind of mix. And so it's really hard if you're looking at trying to pick what are the truly cheapest stocks on the basis of price to earnings. You'd have a hard time doing it using price to earnings ratios in this top chart. Using that same normalized free cash yield that we used in the earlier chart where you got the stair step between the cheapest and the most expensive. However, you get a much more rational, much more intuitive answer that gives you a lot more comparability. So it sort of restores comparability that we think was lost. You could see actually Amazon was the cheapest company at the start of that period. So this would have actually suggested that Amazon was an inexpensive company kind of coming out of 2009. It's a lot more expensive now. It would have told you that Hess was actually an expensive company as it was loss-making on a free cash flow basis. It would have highlighted that Alphabet was at times very cheap, sort of almost as cheap or slightly cheaper than J&J at certain moments. So again, it would have given you a very different signal of what was cheap and what was expensive, and one that we think makes much more sort of rational sense in this asset-light world. And this is one of my favorite charts. It uses the example of Microsoft versus the market. So if you go back to 2010, 11, 12, Microsoft was an extraordinarily cheap stock. It was the second cheapest stock in the market, I think, behind NetApp on the basis of free cash flow. On a free cash flow to market cap basis, it was earning about a 15% yield, meaning the market was sort of implying that it was going to be able to earn back all of its market value in 6 years. It actually had net cash, so the market was even more pessimistic on it. So the market was sort of on a free cash flow basis implying that Microsoft was going to go out of business in 6 or 7 years. And so if you bet that Microsoft was going to be in existence for 6 years, which was if you bought the stock, it was about a $20 stock then, you would have made a fortune. And it looked like just a screaming kind of value opportunity. The problem is, and the black line is the market. So you could see how much those have sort of flipped since, that Microsoft is now one of the most expensive companies in the market, and the market is considerably cheaper, which is also a good reminder of sort of how fickle the market can be. So market participants thought Microsoft should be valued at about 6 times free cash flows, 13 years ago. Now it thinks it should be valued at closer to 40 times, or was closer to 40 times. Or 35 times today. Sort of good reminder of how much things can change and what the opportunity is to take advantage of those cheap valuations. The problem with this is that value managers didn't own Microsoft. It wasn't in the value benchmarks because it's like F5. It is a largely intangible-oriented company. And so it's never going to show up as being inexpensive on price to book. Again, its book value is its headquarters and things like that don't have much relevance for the true value of the company. So we think this really signals some of the tremendous opportunities that were missed by a lot of traditional value measures and a lot of those value benchmarks that didn't own these stocks. And the opportunities that were there for investors that did own those stocks. Tom mentioned earlier Warren Buffett, obviously the great Benjamin Graham disciple. Buffett did buy Apple. He did buy some of these asset-light companies. They looked cheap. And Benjamin Graham had anticipated intangible assets, actually. In Security Analysis, he wrote about it. So operator earnings, as he describes them, are very much sort of in line with free cash flows. They're very relevant today. And Buffett knew that, and he bought some of these cheap companies and did very well owning them.
So this goes to a story that I guess hits me a little bit. Wall Street's perfectly capable of making big mistakes. We've seen it in the past. But I would maybe argue that this is the biggest mistake that the market makes, sort of in broad daylight, in that we showed you before just how elegantly and easily price to book worked for so long. It worked, to the point where the academics, in the very early 1990s memorialized it. I mean, you could argue that it was kind of the seminal work that allowed a couple of Nobel Prizes to be awarded for the work. But unfortunately, it was recognized about the same time it stopped working. And yet, the market doesn't want to let go of low price to book. And the benchmark providers in particular don't want to let go of low price to book. So when you look at the stocks that are underneath the value benchmarks, what you'd see is though even in some cases they use a multitude of different variables to figure out what should be a constituent, price to book still is largely a dominant factor in that exercise. And then when you back up and say, well, which industries have large accounting book values and which do not, what you start to find is that a couple of industries, and in particular energy and financials, have meaningful book values. And as a result, they tend to trade at lower price to book ratios. And as a result, those two industries end up being chronically represented in the value benchmarks. Not necessarily because they're the least expensive stocks in the marketplace, but because they have low price to book ratios versus the rest of the available universe. So we went through this simple exercise a few years ago and said, if you compared a value benchmark to an index that we created that's simply half financials and half energy, what does it look like? And you can see the chart. This is just relative performance of the two groups, that the lines are not identical to one another, but they clearly lay on top of one another. Meaning that when most people are buying a value index, I think they're getting this sort of chronic exposure, probably unintended, to financials and energy, and that those benchmarks truly aren't representing a group of inexpensive stocks. And I think you also have to be aware of this issue to the extent that you hire managers that benchmark themselves against a value benchmark, because if they're utilizing risk tools that don't allow them to stray too far from the benchmarks, which unfortunately is the reality of our industry, you're going to find that they too are unwilling to be completely without the exposure to financials and energy. And I think this issue largely explains why value over that long series of time now, very long series of time, has underperformed the broad market, when in fact it became the most popular category in active management because it beat the broad market over a long period of time. As long as we're kind of hitting on benchmarks and benchmark providers, PEs in small cap can be particularly interesting and problematic too. We hear a lot of people at the moment making the case that the small cap benchmarks are less expensive than large cap benchmarks. And when you look at the numbers, the Russell 2000 here at 15 times versus the S&P at 21 or 22 does in fact look cheaper. But when they do this work, what they're very typically doing is simply taking out of the mix businesses that are not making money. And considering that around 16% of the Russell 2000 benchmarks are currently in a money-losing position, that has a meaningful impact on the overall valuation. So then when you go down and look at things on a free cash flow basis instead, what you see is that the Russell 2000 ETF is trading at a 3.2% free cash flow yield, actually slightly more expensive than the S&P 500, which I think helps explain the softness that we've seen in that segment of the market here pretty recently.
Another advantage of looking at free cash flows is that they tend to be kind of smoother for the index. So if this just contrasts free cash flow per share on a trailing basis, going back to actually, interestingly, the time that free cash flow statements came around. So the cash flow statements weren't mandated until about the mid-'80s. So as far back as we have the data is that. And if you go back to then, you see the red line is generally a lot smoother than the dashed black line, which is reported earnings per share. So Tom already talked about some of the issues around GAAP accounting. There's also been a lot of changes in the rules, in the accounting rules around that period too. So I think in the early 2000s, there were a couple of new rules that were those mark-to-market changes that Buffett decried. And so you even in that black number, you don't have a lot of comparability kind of longitudinally over time. So yet again, we prefer the red line as sort of the valuation measure because it tends to be a lot smoother, a lot more consistent, and less susceptible to rule changes by FASB and so on, and then has endured through that sort of economic transition that we've been highlighting. And then the final sort of point on free cash flows, it also gives you a pretty good measure of future returns, which is ultimately kind of the test of a value measure. So the top chart just looks at the trailing free cash yield in blue on the overall market through the first quarter of this year. And the gray line looks at the annual return kind of subsequent to that starting free cash yield. You'd see in this line, so this is trying to predict, what does the free cash yield tell me about a return 1 year into the future? And it doesn't tell you much. So there is not a great relationship, not very instructive, not very helpful. But the good news is, if you look in that bottom chart, this looks at the free cash yield, same exact blue line as in the top chart, but instead of looking at the 1 year forward return, it looks at the 10-year forward return. And you get a really nice relationship. So you'd say the cheaper the market is on a free cash yield, the better your prospective 10-year forward annualized return has been historically. And so you'd see in the period kind of in 2000, the free cash yield dipped down almost to 1%. You got a pretty low 10-year forward return when you bought in at that moment. You'd see, again, the market looks somewhat expensive today. So you would anticipate, not to the same extreme that it was 25 years ago, but you would anticipate, again, likely a lower 10-year forward prospective return than, if you had bought it, in 2009 or 2010, when we know with the benefit of hindsight, the market was very cheap and the future returns were terrific.
So the last part of what we had put together was to take you through kind of the current market environment through a free cash flow lens, but maybe I should just quickly see if there are any questions about what we've said so far. So if not, I started the industry right there. I didn't intend to put the chart together that way, but it just worked out that way. Free cash flow data became available in the mid-'80s when the Financial Accounting Standard Board mandated that cash flow statements be a part of corporate reporting. And the point of the chart is a pretty simple one in that free cash flow per share generally tracks stock prices pretty well. Over the course of my career, there have been 3 times when that is not the case. One was in the late 1990s. I don't need to tell anybody what happened there. Stock prices got pretty excited about the change that was upon us. And in fact, the change was monumental. I mean, we all know that the internet changed business and changed globalization and all the rest of it in monumental ways. But it goes to the point that you can't pay infinite prices and hope that it will all work out. Cisco at that point in time had a tremendous runway in front of them, and the market saw it. They knew that business was going to double and double and double, and it has. But when you're willing to pay 100 times cash flow for a business, you're paying too much for it. And in fact, that stock has never recovered from that point in time. The second incident, we don't have it circled here, was in the conflict over the great financial crisis. So in fact, fundamentals did turn down, but pretty briefly. Free cash flow per share took a dip. It was largely accounted for by a handful of businesses and then continued to march along. But stock prices gave you a tremendous buying opportunity at that point in time. Correcting or overcorrecting, telling you what you already know about, people's willingness to take risk and the fear that goes, around with it, and the need to get out, which gave everyone else an opportunity. And now we're here, again with a bit of Certainly the Mag 7, certainly a story around artificial intelligence and what it means for all of our futures. And more recently, kind of a broadening out of the market in terms of the leadership into businesses that don't have a lot to do with AI, but maybe are yet again, businesses where people are seeking safety. And among those would be stocks like Costco, Walmart, Visa is on this list. If you expand it a little bit, it looks like Costco. The point of the chart is pretty simple, and that is that in the last 2 years, the leadership of the market has been up and up dramatically. And we don't have a chart in here about market concentration, but any way you measure it, market concentration is at a very high level. Stocks have doubled in a lot of cases in here, but they've doubled importantly without underlying fundamental gains. The sales represented by these small bars, in some cases, are pretty interesting, right? I mean, to grow, a $700 or $800 billion business at a 13% rate in terms of Walmart, it's a pretty big number, but it's hardly sustainable. And unfortunately, it looks like they're plowing all the money back into capital spending, in that there's no incremental free cash flow in the context of that growth. The same is true of Microsoft. All that cash that they're generating, or all that growth that they're generating, is all going back into investments in the business. So the stocks have moved meaningfully ahead of the underlying fundamentals in the business and look to us like they're all very expensive. We don't have a lot of places to do accurate comparisons. There just aren't that many data points through history to look at our current situation and see how it might play out. But we did go through this analysis comparing the market as of the end of March, so about a month ago, with where things were in 2000. And what you'd note is that currently, or as of a month ago, and things haven't really changed that much, the 10 biggest stocks in the S&P 500 were collectively trading at a 2.6% free cash flow yield. That is not a rich level to start with in terms of what you would ultimately expect to earn from that business. On top of that, you'd add something for growth and something for inflation, and in all likelihood, that will look like a subpar return over the context of the long-term history in equities. If you look at the S&P in total, it's trading at a 3.5% free cash flow yield, largely because the concentration in the most expensive stocks is so high. If you look at the stocks in the next 90 stocks, so go up to stock number 100 in terms of size, they're trading a little more inexpensively with a 4% yield. The equal weighted benchmark, which treats everything equal, is trading at a 4.4, indicating that there's some opportunity underneath the surface. The smallest stocks are trading, again, more inexpensively, and then we're able to compile a group of 100 stocks that collectively have a 6.1% free cash flow yield in the portfolio that we offer in the large cap space. If you compare the same breakdown to where it was in March of 2000, and on the vertical here, we have the free cash flow yields. On the x-axis, we have the price return over the 2-year period following the peak in March. The 10 biggest stocks back at that point in time were also the most expensive. They were trading collectively at a 1% free cash flow yield, meaning that if you think things are expensive now, they can certainly get worse. They can get more expensive and more extended than they are. But 2 years after the peak, those stocks were down about 40%. And it kind of goes linearly across that group of stocks. The S&P 500 itself was down mid-20s. The next group of stocks, that group of 90, was down around 20. The equal weighted benchmark, though, 2 years later, after the break, was actually up 10%. And the smallest 250 stocks were up in excess of 30%. Meaning that the market does get it right. I mean, they ultimately focus on the fundamentals and prices get recognized in the marketplace. The other way to look at it in terms of the opportunity set, and it's very similar to the situation we're seeing right now, is that if you look at the equal weighted benchmark versus the cap weighted benchmark, starting in with the peak in March of 2000, The cap-weighted benchmark 2 years into it was down over 40%. It certainly dragged down with it the equal-weighted benchmark, but by the time the S&P 500, most commonly quoted, was back in the black, the equal-weighted benchmark, again, as a proxy for the underlying valuation opportunities that were there, was up around 85%, which again, in our work, looks eerily similar to where we are right now. So that's the extent of our statement, of our presentation today. We do have a large cap portfolio. Obviously, we have a small mid cap portfolio that follows the same underlying philosophy. An international portfolio that is run almost identically to the large cap portfolio. We have a levered 130/30 portfolio, and then we have a newer offering we're calling the Free Cash Flow 500, which is simply more of an index product that's weighted on the basis of free cash flows. I mean, the answer to weighting is that you could do things almost any way other than cap weighting and be ahead of the game over the long term. But weighting things on a free cash flow basis makes quite a bit of sense. So that's
super simple summary is that we think valuation still works. It just matters how you measure it.
That is it.
So we're happy to take any questions sort of on any part of the presentation or any of the kind of the slides on the current environment, if there are any. Or we can go into that accounting slide in a lot more detail. Yeah. Yeah, okay, so the question was why we saw the disconnect between a free cash flow measure valuation and the traditional price to book measure kind of around 2006. And so if you see, so the price to book was a little bit more volatile. It was underwater a bit, in the TMT bubble, and free cash flow would have worked a little bit better. And then it came back pretty strongly. So that was a period when financials and energy had really run up pretty considerably. Like that was, you remember, like GE had gotten into sort of a lot of banking activities, so on, which in hindsight was not so great. But there was so much money to be made, and the financial firms were doing so well that Immel sort of moved into that space. So I think that probably overstates some of the benefit of price to book in that period. It was also where there's a big run up in energy prices leading into the financial crisis. So I think that probably, and we've seen that again, right? Anytime the oil price rallies strongly, you see the traditional price to book based value measures do pretty well. And that's what, like that chart that Tom showed of the 50-50 financials and energy versus the value benchmark, or one of the value benchmarks. So I think it's probably somewhat misleading on the price to book period from 2000, or maybe kind of after the aftermath of the TMT bubble into that 06 period is probably what makes that look a little bit like that performance was so good. And if you indexed it, if you started it in the TMT bubble or in 2000, it would probably have done even better, right? Because it had dipped below, it would have done even better than free cash flow. So does that help? Okay. Yeah. Yeah, so the question was how are we different from Pacer? I'll let Tom answer because I never want to talk sort of about competitors. I will say I think it's great that there is more awareness of some of these accounting issues and that there are other firms kind of talking about these issues. There are a couple of kind of key differences in the way that we look at things, I think, versus what they do. And you all who are looking at funds every day probably have an even better idea than we do about some of those other metrics. But Tom can probably touch on a couple.
Yeah, so a couple things. One, they call their product cows. We call ours U.S. Distillate Fundamental Stability and Value, ETF. I mean, they're much cleverer than we are in terms of how to name their products. And credit to them, I mean, CAF is, the second product and equally cleverly named.
We have name envy.
Yeah, we can't shorten anything, including the title of the deck today. The key differences between those products, though, we use forward-looking free cash flow estimates from Wall Street. We have to do some accounting work to those. We make the same adjustments across the board. There's no bias in what we're doing. But we use forward-looking estimates because the market's a forward-looking mechanism. And again, we want to catch those inflection points and get them right to the extent that we can. So if energy is being priced on a forward-looking curve, and energy prices in the past were much higher, you could arguably, I'm not saying they have, but I'm saying it's easy to envision making a mistake buying into a stream of cash flows that are not there. The other thing that I think is actually more important is that we actually have a quality filter that we apply first when we start with a universe of 500 companies that have free cash flow estimates. And we had the luxury of starting with a clean sheet of paper when we began the new firm in 2017, which allowed us not to have to work with a risk model and some other things that we think are pretty suboptimal in the context of shareholder returns. So rather than use beta or some of the other risk metrics that have become pretty ubiquitously used on Wall Street, we think about risk entirely consistently with the way we think about valuation. And in that, I mean that we think about risk more in the context of whether the embedded stream of cash flows that are in every price are going to materialize and show up ultimately for investors. And we think, rather than stock price volatility being a good surrogate for risk, we think a company's legacy of generating cash flows is actually a pretty good indication of whether they're going to generate cash flows in the future. The other thing we do is we think about debt, because having been value investors for a very long time, we know that even good businesses can get in trouble when they have too much debt, when the unforeseen comes around. So we have a debt threshold, we have a stability threshold that is incremental to the processes that are out there in cows, and then there's another recent entry in the market called flow. And there's some minor tweaks around the edges beyond that, but those two things are the biggest, the forward-looking estimates and the quality.
And they do manifest in differentiated sort of performance over time. You'd see things are a little bit smoother, probably less kind of outsized sector bets at times, and so on. Yeah. Yeah. So the question was if we make industry-specific adjustments, and the answer is no. So the beauty of this is that we've sort of tried to restore comparability across industries, and you can see. So the traditional accounting measures, even within industries, you can end up with, if one company is sort of a serial acquirer, and it goes out and buys companies, it then writes up the excess of the purchase price as goodwill. And so it might look really cheap on a price-to-book basis because of all that goodwill it's created. And another company that's in the exact same industry, say two pharma companies, if it's doing all of its sort of growth organically through R&D, it's never going to write up anything in the way of book value. So you're going to get on other measures pretty big differences even within industries. But what we do, it doesn't matter what the industry is. So we make systematic adjustments up front. So there's like health insurer cash is not there for you as an owner of the company. So you need to take that out of the enterprise value. Companies in certain in tech in particular issue an enormous amount of options. So they dilute you as an owner of the company. So a free cash yield that looks like it's 6% if they issue 2% of the shares every year, well, it's not really a 6% yield because they have to use 2 of that just to keep you whole. So we have to make adjustments for things like that, off-balance sheet leases for retail. So from our experience of having been analysts, as Tom pointed out with his TV reference going back all the way to the 80s, having been analysts kind of across a bunch of different sectors over a long time, we've spent a lot of time in cash flow statements, talking to managements and so on to try to understand all these nuances and things you need to adjust for. So we're trying to draw on that fundamental experience as analysts to then kind of create a systematized methodology that works across industries and across geographies. So you get different accounting rules in Europe versus so IFRS versus like different on sort of like the development of research or things. Some of those things you can capitalize internationally that you can't here. And so again, your PEs aren't going to be comparable. from a Swiss company necessarily to a U.S. company, but our measure of free cash flow will be. So that was the whole goal, was to kind of put everybody on equal footing, regardless of industry, regardless of geography, regardless of size. So it should work in the small cap space if it works in the large cap space. So we don't have to make industry adjustments. The one that I would mention, if you look at our portfolio, because of that debt threshold that we have, again, we're really focused on the preservation of capital. We will kind of be chronically underweight capital market stocks, so balance sheet driven banks. We will just not own because they're so highly levered. So that would be the one, and it's about 4% or something of the S&P 500, where we will just kind of pretty much always be out of that space. We own other financials. There are lots of good insurance brokers, payments companies, other things like that will give us a financials weight that at times is sort of comparable to the S&P 500, but we'll always be underweight in those kind of really levered balance sheet driven banks. Thanks. Anything else? We will be around too, so just come ask any questions. We appreciate your time so much. Thank you for sitting through this, and I hope you guys have a great rest of the conference.
Thank you.